the cloud. All right, we're ready to go. Our own brothers, everybody, if you guys haven't met me before or seen me, I work really hard to be smart in all areas of finance, taxes, money, retirement planning, all of that. And one of the specialties I've had over the years is teaching families how to pay literally the least amount of money for college possible. It goes on my own background, which I'll explain to you guys in a few minutes here. And so when we run through for the next hour, 45 minutes, somewhere in there, I'm going to walk you through a proven 5-step system that we've used for 27 years, helping families all across the country. I've trained other advisors on how to do this, pay the least amount of college, no matter how good of a student they have, no matter how much money they make, or how much they've set aside for college. So as we go through this, I'll turn my camera off in a minute just because it eats up a ton of resources. But as I go through this, really pay attention and please don't assume that this doesn't apply to you because you make too much money. Really, you're going to see some cases that'll be very shocking at how much money these people made and just how much aid they got because they understood the system. And then when all is said and done, when the class is over, we'll tell you how to get more information and what to do next. So I think you're really going to enjoy it. I've taught it for years. I actually taught it as a paid class at the local community colleges here in town. And it was, I think, 25 years ago, we were charging $40 a person. And it was the highest rated single class they had that you could come and take on a Saturday morning. So buckle up. If you're taking notes, you're going to love it. If you want to screenshot anything, like I'm going to go fast. I can't send you the slides, but you're welcome to snap pictures of anything you want. So without further ado, I'm going to turn this camera off so we can just focus on the material. Like I said, Zoom gets slowed down sometimes. And at the very end, there's a gift. Stick around for, I think it's a $247 gift. But basically, here's what we're looking for. We're going to show you how to get the free money that you've heard other people got, but a lot of people don't know how to get it themselves. So that's what we're going to show you about tonight. If you guys aren't familiar, my website is roncarruthers.com. It's predominantly, I'm actually redoing it because it's predominantly college-based, even though the majority of what we do, by majority, I mean like 60–65% is actually financial and tax advisory things. And those are my other handles. I haven't been doing a lot on Facebook lately, although that will change pretty quickly here. And there's my Twitter handle. You guys can feel free to check it out. But if you're a parent that didn't save enough for college, and perhaps you're feeling guilty, or you just looked and saw what college actually costs, let me show you a statistic that'll maybe make you feel better and let you know you're in the right room. This is according to CNBC. The average family in America has saved enough money to send one kid to college for half of a year. And if you've ever seen the usdebtclock.org, that website tracks kind of like all the debts and mortgage debt in the country and all kinds of stuff like that. And their statistic, I'll zoom in here, shows that college debt right now, today in America, is even worse than credit card debt. And here's the zoom in of the numbers. Now, these are from a few months ago. They're even higher now. But student loan debt is almost $1.7 trillion of money, as opposed to credit card debt. All the credit card debt in the country is just over $1 trillion. And here's what's misleading about this. If we go back to this screen, over here is the mortgage debt, if you can see that, and credit card debt and student loan debt are all next to each other. And the reason this number is misleading is it really only tracks credit card and student loan debt that they've taken directly from the colleges themselves, like actual parent loans or subsidized loans or Stafford loans. So what it doesn't count is if your next door neighbor or you put last month's tuition on a credit card, that's going to show up here, not over here, and yet it's still college debt. And I'm sure you know somebody who's done that. Or if your neighbor or you refinanced your home to pay for college, that's going to show up on the mortgage number. So the problem is like out of control. And we're not going to talk tonight about whether college is worth it, although I teach a whole other class on how to get in and how to make sure you actually get a return on your investment. This is strictly going to talk about how to pay for it, but here's a number that should blow your mind. Now, compared to 1.7 almost trillion, senior citizens owning $18 billion in student debt isn't that big of a deal. But here's what it shows. People are getting to the age where they're collecting Social Security, and their Social Security money is going towards paying off their student loans. And so it really is a problem. And what we're going to show you tonight is the one thing, it's a 5-step process that should set you up to pay half or less. That's what we're shooting for college, which is going to free up money for all other areas of your finances. It's more money that you can put towards retirement. It's more money that you can live on, pay down mortgages, all those sorts of things. So the goal here is to get you a great, or your student, a great education from a top school for a fraction of what your neighbors or your other friends pay. My son, the tall one, graduated from Northeastern, totally debt-free. That's him. That's his little sister, the baby of the family. My daughter went to USC for even less than that. That's me and my wife. That's my daughter and her husband. They live in London now. That's the Tower Bridge. It's like 4 o'clock in the afternoon. We went last December. And those lights in the background, like how the clouds are kind of lit up, that's just lights from the city. It's been pitch black for a bit at that point. And there's her actual award. So like there was a freshman grant, a Cal grant, a Pell grant, a university grant of $17,000, a CIOG grant. That's real money for my student when she was going about 10 years ago. And my youngest is going to Berkeley for the cost of her food. The asterisk is there. That's when she graduated from community college and then transferred over. That's my kid's mom, by the way, right in between us there, photobombing the picture. But the reason there's an asterisk next to the food is because she's vegan. For some reason, vegan food ends up costing a lot more than if the kid would just eat hamburgers and steaks. So as we go through this tonight, I'm going to show you, again, 5 steps to formula. And what I'm also going to try to do is explain to you the biggest myths that really keep other parents from getting aid, which is probably why you've heard it's hard to get aid as well. That's me and my wife again at the French Laundry. If you guys have ever been, my nickname in the community of college planners is the Godfather, because I've been doing this pretty much as long as anybody and taught many of them. I actually invented a career planning methodology to help ensure that your kid goes to college and it's worth it. It's actually industry standard now. I founded a franchise that a business partner of mine runs now called Duceris, your total college solution. And for the last 27 years, I've helped families get more free money for college while simultaneously figuring out the best way to pay the difference without affecting their lifestyle and their retirement. I already told you about the one kid who went to USC, the kid going to Northeastern, and now the one at Berkeley. That's my dog. You'll see her in advertising. The reason that picture's in there is simply because it took me a long time to get her to sit still for that photo, so that we're going to use. And so I wanted it in there. She did not go to college, by the way. That's a fake photo. I've been quoted a bunch of places, most recently Forbes and Fortune. And that photo was officially the day I decided I needed to start losing weight. I couldn't believe they stuck me with the skinniest girl they have on set to be interviewed. I get in there a bunch. It's actually a really nice local San Diego news station. And their big news, I guess, is CDC released a coronavirus patient by mistake. So now we've got a couple of cases of that going. All right, here's what you're going to learn tonight. Number 1, how to pay less for college, so you can save more for retirement and enjoy the next few years without worrying about it. The 5-step formula, and how to avoid the biggest mistakes that other families make, so you can really stop worrying about what they are saying about how expensive college is. And the reason this is so important is most of the traditional planning is dead wrong. Like literally on Twitter, before I jumped on this, there was people going back and forth, totally misunderstanding how 529s work and how they can hurt you. and just clueless. And this is someone, like, someone calls themselves, and again, no disrespect intended to this person, but it's someone whose like Twitter handle is something related to finance. And absolutely all the research that they turned up gave them bad information. College right now is getting more expensive by the minute. It can cost over $250,000 per student. And if you borrowed that money, like we were showing so many families did on those student loans, it really means you'd be paying back about $378,000. That extra $128,000 is the fees and the interest. And if you did it that way, your payment would max out at $3,149 a month, and it would run for 10 years. 529 college savings plans can hurt you more than they help you, like I was just mentioning. And again, that's a big myth. And the bottom line is, though, if you understand the system for who gets money and who doesn't, you don't really need to be worried about all this. Now, again, our goal, many of my students go to college for free or for room and board, but the goal is to shave half off the price, and that's what we're working on. By the way, if you're not familiar with my work, basically, my entire business is financial and tax advisory. I'm an independent fiduciary financial advisor. Independent means I don't work for any one company. We're independent. We find the best things for our clients, regardless of who's delivering them. Fiduciary means we always act in our client's best interest. And really what we do is we help people find money that they're losing unknowingly and unnecessarily in many areas, not just college. So if this is your first exposure to us, we talk about mortgages, we talk about paying less taxes, how to set up your retirement the right way. The rest of the presentation, we're going to focus exclusively on college. But we also talk about how to fund your major capital purchases, cars, weddings, vacations, things like that. So here's the 5 steps of the process that we're going to go through tonight. This is your syllabus for the rest of the evening. Number 1 is we are going to go through how to understand the rule book and how it applies to you. Number 2 is we're going to talk about the 3 questions you have to ask every school to determine whether they have money or whether they don't. We're going to talk about how to pay your share of what's left over and some ways of cleaning up inefficiencies there. We're going to define what it means to file your forms both accurately and on time. And we're going to talk about the 5th step of the process, which is how to negotiate with the school or schools when it's appropriate. So without further ado, we're going to jump right into the financial aid rules. So here's what you need to know. First of all, the rules are created by Congress. So if you guys follow Congress at all, you know that Congress does not always do things that make sense to sane, rational people. Doesn't matter what side of the aisle you're on or who you're voting for in November, they're just kind of hot and dysfunctional. The other thing that you have to know is that the Higher Education Reauthorization Act is 847 pages long. And so inside that, now I teach these rules to tax professionals. They laugh at that because the tax code is 77,000 pages long. And we're like, I get it. But look, it's 847 pages long and it ain't fun reading. So most people don't even bother to read it. And that's a problem. And I'm not saying you should, I'm just saying this is a problem. They calculate what you can afford based on 101 criteria. When you print out the formula, it's actually 36 pages long. And the rules don't always make sense because Congress made them. So there's loopholes and exemptions and things that just don't make sense because Congress. And what I'll do, just so you guys know, is after each point, I'll stop and see if there's any questions. But understanding how these rules apply to you is literally step number 1 in saving you money on the costs of college. And what you really need to know about it is, just like with tax planning, if you have a little bit of understanding, you can save yourself a little bit of money. Put money in your 401k, get a mortgage, write it off. with a more complete understanding of how like business entities and LLCs and family partnerships and all those things, you can save a ton of money. It's the exact same here, except this is actually easier. Again, think in terms of an 850-page manual versus 77,000 pages like the tax code. And if you're playing along at home, the 3 magic letters, if you're taking notes, that you're going to want to write down are EFC, and they stand for expected family contribution. And the formula that goes along with that looks like this: cost of attendance minus expected family contribution equals need. And so if you're not taking pictures of any of these screens or writing anything down, this is like literally the first thing you probably want to write down. So we're going to show some examples of this in a moment. But one of the things that's really interesting about this formula is the EFC doesn't necessarily change in your situation. The cost of attendance does, which can change your need. So if you have a public school, that's $30,000 a year. And by the way, when we're referring to cost of attendance, we are referring to tuition and fees and room and board and walking around money, books, all that stuff. So it's the entire thing. So here in California, the state schools, Cal State system, might only cost $6,000 or $7,000 in tuition, but this whole thing costs closer to $30,000 once you factor in everything. So if a family has an expected family contribution that's $20,000, then the difference is $10,000. Cost of attendance, expected family contribution, need. And by the way, this family contribution could have been a $40,000 family contribution that we got down to $20,000, or it could be a $20,000 contribution that we might get down to $14,000 or $12,000, which only means this number is going to increase need. By the same token, your kid might be looking at a private school. Notice the expected family contribution didn't change, but the need now did. Now that doesn't mean you're getting that need, it just means that you're eligible for it. That we'll talk about in the second section of this. So just kind of summarizing one of these initial points here is don't be shy about picking schools that are expensive necessarily. And understanding what your EFC is and how to lower it is critical in the starting point of the process. So let me show you a case study. And I deliberately picked one of the most obnoxious ones I could come up with, which is a client down here in Del Mar. If you guys know the area at all, it's where the rich folk live. She had a $2 million home in Del Mar, and she had a $2 million paid for beachfront condo up north in the Orange County area. The family consistently made $100,000 a year of income. Now I want you guys to stop for a second. If you met her at a party or her husband, and you just knew where they lived, and like, oh yeah, we have a condo up in Laguna Beach on the water, and yeah, you know, he does this and I do this. Be honest. You guys would assume there's no way in hell that they would ever get any money for college, right? I mean, let's just be real. And by the way, if they didn't know the formula, they wouldn't have. But understanding the system and what counts and what doesn't, all 3 of her kids went to private universities. We averaged $43,000 a year in free money at all top 100 US News and Consumer Review ranked schools. They all came in the top 100. So it wasn't like Bob's College of Design that's run in Bob's basement. These are heavy schools. Not necessarily Ivy Leagues. 2 were back east, 1 was in the Midwest. So just the planning, the cleaning up the 529s and the other stuff in cash, tax-free cash, was worth over $500,000 to them. And literally all we did was the steps I'm showing you. We went over the rules, got their EFC down, picked schools that had money. There were some spikes in income over the years. I'll explain later. We just went through 1, 2, 3, 4, and 5, all the steps I'm showing you. Don't believe me? There's the award letter from Wesleyan. $42,217 in a scholarship, and then for whatever reason, kind of seems like a waste thing to me, They gave her a $300 matriculation grant. They could have just included in there, but I guess it was like a one-time only grant. And then there was some loan money in there as well. But the free money was almost $43,000. Think it was a fluke. There's her other kid who went to Washington University at St. Louis, $43,000 a year, $43,962. Average amount, we're right at about $43,000. By the way, the older kid went to Boston College. When we moved offices, I didn't save that award letter. So something to keep in mind. Just the one kid, the planning was worth $178,000 in free money, tax-free money. And if she had to borrow that portion of it, still had to pay for the room and board, she would have had a payment of $2,200 a month for 10 years, a house payment in many parts of the country for just one of her kids. Now multiply that by 3, it's like $6,000 or $7,000 a month payment. And ultimately, they would have stopped lending her money and her kids wouldn't have been able to go to school. But just on this one kid, because she didn't have to borrow this $175,000, she saved $265,000 in interest. So before we move on to step 2, let's take a look at the questions. Someone's got a big amount, anonymous. In 529s for the 2 youngest, stopped adding this past year. It actually used $15K for private school for the oldest. What would your strategy be when all is said and done? I would tell you we need to chat about that, because I can't, without knowing the tax consequences, like how much is growth and how much is gain versus principal, what you put in, without knowing what schools your kids are looking at, without knowing the other pieces of where you fall in this EFC formula. I can't legitimately answer that, but I will tell anybody on here how to book a strategy session at a discounted rate, like heavily discounted at the very end. And I promise you the time will be worth it. It'll save you 10 to 15 hours of research on your own. And by the way, for anybody that takes me up on it, which has never happened, but if you tell me that it was a waste of your time, we'll give you the strategy session feedback. So, but it's really good to pay attention to. And time permitting, I'll tell you guys a story about a client where we moved to 529 that was about $100,000 right at the last minute, and what happened there. I don't have the proof for it, but I can get it for you. Okay, step 2. You got to know which schools have money. Now, I say ask this. Really, the right answer is you have to research it about every college. And here's question number 1. What percentage of need do they meet? So remember, we had the cost of attendance, we had the expected family contribution, and we had the need. Now we want to know how much of it are they going to help us with? And of course, the answer we're looking for is as close to 100% as we can get. Then we want to know how much of it is free money. And then the third question is, how long does it take on average for the average student to graduate? So 3 questions. So here we go. Let's take those same 2 schools. We got a public school where the need was $10,000. And now here's the answer to question number 1. They meet 50%. Here's the answer to question number 2. 50% of it is free. And here's the answer to question number 3. Did I say that right? It takes 6 years to graduate. So if the need is 10,000 and the school's helping with 50% of that, who pays the other 50%? If you answered you do, you get to move to the front of the class, because that's the right answer. You get stuck with that on top of whatever your family contribution is. By the way, if half of it is gift aid, the other half will be loans or work study. So someone's actually got to pay back the other half of that too. And if it takes 6 years to graduate, that just means you're paying over a longer period of time. So in this example, the school gave this family $2,500 a year, but the parents had to pay or borrow $27,000. Now let's take a look at our private school where we had a much higher need. And again, you would look at that and think like, well, we can't afford that. And I'm not, by the way, I'm not saying to only apply to private schools. About half my clients go to schools that are public, about half go to private. The difference is Most people know about the public school option. They don't really understand that a private school can be affordable. So in this case, there are many, not all, but many private schools that will meet 100% of need, and some will go as high as 92 or 95% in gift aid. So there's your answer to question number one. Question number two, and there is a difference where a lot of private schools, the majority of them, the majority of the students do graduate in 4 years, not the 5.8 that it can take at a public school. So in this example, the private school is giving $46,600 a year. The parents are paying $23,400, less than they were paying over here. And by the way, if you think, well, that's bullshit, that can't be true. Just think about the 2 award letters I just showed you from a lady that was getting pretty much that free amount for not 1, not 2, but all 3 of her kids. And she was someone that you would have guessed would not normally be eligible for aid. By the way, if you work the math on how long each school costs, because of the longer amount of time, the likelihood that the parent pays $165,000 versus $93,000 out of pocket is great, which means the difference is $71,000 less to go to the quote unquote more expensive school. Now I want to make a point here. This is not the exception to the rule. For my clients and people that understand this system, this is the rule. I'm not saying don't go to public schools. I'm just saying you don't have to ignore the private schools just because you think they're too expensive. They can often be the same, less, or so close in the ballpark that it really becomes a decision of what is best for your students, not necessarily what you think is most affordable. I got stacks of these stories. I just only have an hour to tell them. So recap number one, understand the financial aid rulebook and how it applies to you. Recap number two is, again, you must know which schools have money and which schools don't. Now, step three is you have to figure out where you're at for retirement and how to pay your share. To that, we turn to Dr. Stephen Covey, who wrote the 7 Habits of Highly Successful People. And actually was listening to a Scott Adams book the other night where he recapped those. And, seek win-win, begin with the end in mind was principle number 2. I forget what number 1 was. Sharpen the saw daily. Seek first to understand, then to be understood. But the one we're focusing on is beginning with the end in mind. And a wise man once said, they will lend you money for college. They will not lend you money for retirement. By the way, I was that wise man who said that early on in my financial planning and college planning career when I figured out, man, they'll load you up on debt, 1.6 trillion, but you come get retired, they're not going to really, nobody wants to help you out on that. So you want to figure out where you're at for retirement, and it's bad for a lot of folks that come my way. It's bad, but we need to know. And by the way, I just did a class last Saturday. If you email my office, I'll give you the email at the end here. We'll send you a link to about an hour workshop on the process, the 5 steps that we go through for that. But really, the reason we want to know that is because then we can come back to present day. And there's only 3 real ways to pay for college. Now, remember, we got your share as low as possible, hopefully half of what it was starting out. We made sure we found schools that had money to give, but then we still have to pay something. Even my kids who got amazing deals had to get something. So we have to pay out of income. We have to pay out of assets, sell stuff, or liquidate cash, or we have to borrow. That's it. Those are the only 3 options we have. And so which one of those, or which combination of those, that's best for your family, that will result in the most efficient and comfortable strategy for you, in part depends on where you are at retirement. So we'll run into families that'll say, I don't want to borrow, I want to pay out of my income, but whether that's a good idea or not depends on how set you are for retirement. So it really is something worth paying attention to. And we had a case a few years ago where they kind of fell into that public school thing, where it was a mom, dad, 3 boys. They all went to state schools here in California. We didn't get a ton of money for them. We got like $2,200 a year each, which wasn't great, but it wasn't terrible either. If you're not supposed to get anything and you paid me a few $1,000 to set it all up for you, and you get, almost 10 times that back, not terrible. But here's where we really saved them the money. They hadn't saved for college, so we developed a strategy to efficiently pay their share that saved them ultimately $95,000, almost $100,000 in interest and fees over the way they were going to pay for it before we met. And so I'm trying to get this mouse moving around here. And so if they invested that money, they would, at a very low rate of return, modest rate of return, that would give them more than $250,000 in future retirement savings. And again, we saved more here in this piece of it, this third step, than we did up here in actual free money. And so I always say this step is the one that everybody overlooks at first, actually has the greatest long-term impact for families. And because it sets them up no matter what else happens. Gives them, when we did a poll a few months ago about why people hired us and worked with us, the 2 things they said to us were peace of mind and God, I can't even remember. It starts with a C. It wasn't consistency. It was basically that they didn't have to worry about things being done right. They knew that they had the peace of mind because they knew that everything was done right and set up for their long term. But this is a huge step. So again, it's part of a process. Get your share as low as possible. Pick schools that are affordable on their own or that have money. And then finally, make sure you're on track for retirement. If not, make sure you figure that piece out before you figure out how you're going to pay for college, or ideally at the same time. Moving right along to step number 4. You need to fill your forms out accurately and on time. Let's define both of those. Accurately means legally filing them as completely as possible, but playing according to the rules. Now, what I already told you about the rules, Congress makes the rules. So Congress puts all kinds of loopholes in it. You don't want to end up like Felicity Huffman or Lori Loughlin getting in trouble for breaking the rules. But inside the rules, there's a ton of latitude. So a lot of people make mistakes on this. In fact, our most recent numbers show 4 out of 5 families make mistakes here. Now, there's strategic mistakes, like having tons of money in a 529 if you're otherwise eligible for aid. And again, a lot more of you on this call or webinar or whatever we call this are eligible for aid than you realize. Again, think back to that first case study. But 4 out of 5 families make mistakes when they go to fill out the paperwork. Tactically, meaning they didn't plan right, but more commonly, it's they just misunderstand the definitions on the forms. So some of the biggest mistakes, if you switch jobs during those years and your rollovers get counted, they can treat that, if you don't check the right box, as if you received the money and had it to spend and will continue to have it to spend. If you're separated or divorced or were never married to your kids' other parent, there's a whole other set of rules that apply there. And again, it's trying to keep this to an hour. When I taught it live at the community college, it was a 3.5-hour class. And the number one complaint we got was that it wasn't long enough. So I'm trying to give you the skeletal framework, but just understand there's a whole series of mistakes that you have to look out for and opportunities that you can pay attention to. And the granddaddy of them all is people that improperly report assets. Now I want to stop here for a minute. I want you to understand, if you're sitting here listening to this and you're like, yes, but my friends say that they applied and they didn't get aid, I want you to understand 4 out of 5 of them made 1 or more critical errors on the paperwork. The odds would have it most of them are generally these three issues right here. Then they don't get any aid because they screwed the paperwork up. And then they turn around and tell you and your friends and your other kids' parents' friends that it just doesn't work out. It's really, you're not going to get any aid. I didn't get any aid. You make more than we do, or you have a bigger house than we do. You're not going to get any aid either. So that's where that myth comes from. And so again, not 100% of the clients that we work with get need-based financial aid. Actually, most of them do, because we screen them in the front and we can tell them, hey, you know, for the schools you're looking at, you're not going to get aid. Do this and this and this instead. But don't assume that money is the factor. It's not. Now let's talk about on time. So what is the definition of on time? So it means filing no later than the end of January of the year. It shouldn't say before your student goes to college. It's the year your student does go to college. So scratch that out. No, bad. The year your kid goes to college. So if you have a senior right now, you should have filed it by the end of January. Got a junior, we want it done by the end of January. Or we want it done whenever the school tells you it's due. Some schools have earlier deadlines, but it's not October 1st. And that's a misconception that's gone around a lot ever since that rule was changed 5 years ago. Before, you couldn't file it before January 1. By the way, the answer is when it needed to be filed was still the same. It was still by the end of January. But Obama, right before he left office, made it so you could fill it out on October 1st. And we actually recommend you don't. Even though you hear the myth that, oh, first come, first served, that's only true if you're late. And late is generally, as long as you're in by the end of January, you should be fine unless the school tells you sooner. The problem with filing on October 1 is most of the system goes live right on October 1, and it's very glitchy right then. And so we don't recommend it. A lot of mistakes get made. You don't need to do it then. And if your kid hasn't even applied, there's nothing for them to do with the paperwork yet. They're literally not going to do anything with it. And it's a pain in the ass to fill out. I wouldn't be lying to you if otherwise. By the way, it's not as bad as the CSS profile, which the private schools require, which is like 3 times as long. And it has, the FOSS is just a bad form. The profile is evil. It asks like trick questions, like it asks the kids section, hey, how much can your parents afford for you to come each year? And if your family contribution should have been 10,000, but your kid writes that you can afford 20, guess what your new family contribution just went to at that school? And I'll give you one example of client making a mistake on this. We met someone a few years ago that had been making $250,000, got laid off. So he was working at Home Depot. She was over at Starbucks. And they over-reported their assets by $800,000. We didn't need to tweak anything. We didn't need to move any money. They just made $800,000 worth of mistakes. By the way, very common, happens all the time. Well, thank God they came in for their consultation, their strategy session, because we got it fixed in session. It got them an immediate $5,860. But the following year, they got free tuition at San Diego State down here, and the $5,860, which covered part of the room and board. So attending the class, coming in for the strategy session, was worth pretty much an instant $12,000 a year to them, and the kids still had 3 years to go. So it was worth almost little over $40,000. We got this money for the first year, the second, and then we got this money for the remaining 3 years. So it worked out. But real common mistakes, smart people, the directions are just really poorly written. I had a buddy's wife. He died 5 years ago. He left his wife $3 million in life insurance. His brother had died of the exact same thing a few years earlier, so he had loaded up. And again, there was we were able to accurately file her forms, but exempt the $3 million. So it didn't get reported. So it meant her girls got free tuition at UC San Diego, University of California, and another $3,100 towards living expenses. One of the other daughters went to a Cal State school. She got the same thing, free tuition, about $3,100 a year. Now, if you're listening to this and you're like, man, she could have paid that $3 million. She could have paid out of that $3 million herself. Maybe she could, maybe she couldn't. But the point was, we did not pull any shenanigans. We understood the rules. It didn't take away from any other families. These are state and federal grants that we received, and she was eligible. And by the way, my buddy was the breadwinner. He was like 46 when he died. She's like 42. They had a 7-year-old. This lady's never worked her adult life. She was a stay-at-home mom. There's no way she could stay in the standard of living. This money has to last her the rest of her life because they were upwardly mobile, didn't have a lot of retirement savings. So again, learn from the example. Don't judge it and be like, it's not fair. You know, just understand there's a methodology to this. If you guys know Carlsbad at all, because I know we got people on this from all over the country. Carlsbad, where I live, about 30 miles north of San Diego, right behind my office, are the world famous flower fields. I don't think they're actually world famous, but real pretty flower fields. Legoland, and then every golf manufacturer pretty much known to man. So I have a bunch of golf executives as clients, like the sales guys or manufacturers reps. They'll make about $150,000 to $180,000 a year. And this guy makes closer to 180. But back to his situation, he had cash in the bank. He had a rental with equity. He's making 6 figures. And yet here's these kids' grants from Gonzaga, whichever is the right way to say it, that total about $18,700 a year, $75,000 a year over 4 years. That was pretty good. Not as good as his daughter, who went to USC a couple years later, who's getting $40,000 a year, if you guys can see that there, in gift aid. Not state grants, not Pell grants, not any of that. Like their own money because they followed the system, the formula. And she might have even done a little bit better than my daughter did. I have to go back. I've never put the slides side by side to see if she got more money than my daughter. I gotta go check that now. So understand that there's all sorts of special circumstances. If you're a business owner, how you report the value of your business. If you own rental real estate or a second home, how you report that. If you have a portfolio, if you make over $250,000, all those things, if you're divorced, all those things need to get factored in. So don't assume that any one of these kicks you out, or even all of them. If you're a business owner making over $250K and you have rental real estate and a stock and mutual fund portfolio, the worst disservice you can do to yourself is assume that you don't qualify. Step number 5, we're coming into the home stretch here, guys. Hang in, got about 10 more slides. You can negotiate an appeal and award letter when it's appropriate. So let me explain what that means. In step 1, we got your EFC as low as possible. Step 2, we researched what they were supposed to give you. But let's say a school doesn't give you what we estimated that they should have, or another school gives more, or really the more common one, that there's a change in circumstances since they are in fact looking back 2 years. Got a family right now, made $290,000 in 2018, but he lost a job. They had to pull from an IRA. She lost her job. They'll be lucky to barely make $100,000 last year, 2019. The schools look back 2 years. So a lot can happen. When do people get divorced? When the kids are getting ready to leave the house. Now, we're not saying you should do it to get financial aid, although one couple did. They're kind of already on the rocks to begin with. But you lose a job, you switch a job, assets that you had in 2018 aren't around anymore in 2020. You had a bonus, or you're a lawyer and you won a big case, or something like that. You can explain that away to all the schools. So for instance, that mom, the very first case study number 1, the big house, the kid going to Washington University and the other one going to Wesleyan. The older kid had graduated. She did real estate and she had a great year 1 year, like great. We were able to show the school that the following year wasn't really off to that great of a start. And both the schools, Wesleyan and Washington University, let her keep those big awards, those $40,000 awards despite their net income going up over $100,000. And I can't tell you, I had a client working for Anheuser-Busch when they were bought by InBev. He had to cash out $300,000 of stock options. We had a Catholic client who sued the diocese down here in San Diego for a sex abuse case, and won a pretty good sized settlement while both his kids were going to private Catholic universities. And I never got an answer from him on how that works if you're a Catholic suing Catholics. He didn't really want to talk about it. But anyway, the schools left him alone. Got to keep the exact same award, so you can't appeal this. Now, one story from a few years ago was a teacher at my kids' high school. Sadly, she wasn't either of my kids' teacher, or they would have gotten an A for sure. They were giving her and her husband a hard time about the business property. He's a doctor and owns like the building that his business is in, and a rental house. His mom had passed away and they inherited this little rental house. So in the appeal process we went through, documented the values of each property, and here's the crazy part of the story. They had originally offered $6,100 a year of free money. Now remember, it's a doctor, it's a teacher, they got money, they got property, and we figured they should have given them like 10 or 12,000. So like, 6,100 is a little bit light. When we went back and went through this process, the award went from 6,100 to 26,000 a year, a $19,900 increase. Now, most of our increases are not that great. They're 5,000, 7,000. We have pretty good award in most cases to begin with. But when we appeal, we don't always get 5-figure increases, but we get at least 1 or 2 of them every single year, where had they not asked, had they not strategically planned ahead, had they just listened to me teach this class and not followed through and researched this for themselves or gotten a little bit of guidance on this, they would have not benefited at all. But in some cases, we can actually go in and further tweak that and get a 5-figure payout, or $80,000 over 4 years in this kid's case. We had another mom that I met when her older kid was going to ASU. She's out in Arizona, and her youngest is in Hollywood type stuff. In fact, I think she moved from Hollywood to Dallas and is now moving up to the Bay Area. She does like PR, and she was a producer on Entertainment Weekly or something, one of those shows. Anyway, here's her comment. Well, why does she love me? Because we got her, the first kid got nothing. This kid got $31,526 a year. Again, 6-figure income, trusts in the kid's name, 529s when we met him, all those sorts of things. So again, please don't assume that this doesn't apply to you. And then finally, before we get to wrap up, but stick around, you want to see what's coming next. If you make over $180,000 and own a business, I invented with 2 other CPAs a methodology. Actually, it's now if you make $160,000 to write off the tuition using a little known but perfectly legal, I teach it to other CPAs, loophole called the tax scholarship. I literally invented this sucker. And by the way, I teach accountants, and not 1 out of 1,000 know how to do this. And it's the same reason that your family practitioner doesn't know the latest in heart surgery techniques or bloodless heart surgery techniques. It's not what they do. They treat a sprained elbow, they treat colds, and then they refer out to the specialist. When it comes to college, we're the specialists on this. So we can show someone how to do that. Saves them $5,000, $10,000, $15,000 a year on taxes, plus whatever aid they actually get. So again, if you're in that high income slot, you perhaps own a business or have some stuff, please don't log off and think this didn't apply to you. We weren't talking to you. I was definitely talking to you. So let's recap this. I'm going to throw a couple other things in here for you. Number 1, got to know the rules, how they apply to you. Number 2, know which schools have money and which don't. Talked about those 3 questions. Number 3, we got to figure out where you're at for retirement and then back into today and figure out how to pay your share. Number 4, we can fill your forms accurate. You got to fill them out accurately and on time. Remember that definition of accurately and on time. We negotiate with the schools when appropriate. And then one last thing to keep in mind is you do have to be prepared for a last-minute ambush by a school to get you to prove everything. Now, it's called an audit. Don't freak out. It's not an IRS audit. It happens about half the time. And they just have to follow through. And to satisfy the federal government, they have to audit a certain number of files. And some schools just audit everybody's files. Literally, they call it 100% verification when they go through and do that. And so what we don't want for you after hearing this class is we don't want you to go in and be like this one guy who literally fled the country. You can look this article up. His name's Chad Albright. I love this. He fled the US. He went to China. He's going to die of coronavirus. He fled to China to escape debtor's prison. I had to escape this prison. And this is from June 12, 2019. This is the USA Today article. I don't even think he owed that much, relatively speaking, but we don't want you to be that guy or your kid to be that kid. So what I do offer is we charge for strategy sessions. However, I am waiving the majority of that fee if you want to take advantage of that. And if you just email us, info@roncarruthers, and say you were on the webinar, Stephanie will book that for you and figure out how you want to take care of your 97 bucks. I promise you it will be worthwhile. What most clients tell me is that it saves, like I said, an average of 10 to 15 hours of research. Now, when we go through that hour, sometimes they go 75 minutes. Sometimes we just had a family. They got an extra hour because we didn't finish. I'm just like, you know what? I'm not trying to, we have more issues here. I want you to get your value. But when we finish that, you will have a working action plan of knowing what to do. Now, one of two things will happen. One is you'll know what to do. You'll like to do things yourself. You'll be great. And again, that will save you 10, 15 hours of research, and it'll make sure that you get the right information. I used to have a slide in here. In fact, I got to put it back. If you do a Google search on get free money for college, the last time we looked, it was like 11 million to 14 million results came up, like some ridiculous number. That's information. What we're trying to do is give you insight. And insight is knowing which of those 11 million search results are the right ones. How does the 529 rule work in your specific situation? Do you keep it? Do you gift it away so it can be given back to you? Do you liquidate it? I don't know. Depends on the rest of the numbers. Is your student looking at the right schools? Do they need to improve their SAT? Are they going for the right career? These are all things that we discuss in this strategy session. So I've got a couple minutes here. If you guys have any questions and you want to type them in real quickly, that would be great. But what I can tell you, just in kind of closing here, is I've worked with over 5,000 families. Now, I've been at this a long time, so it's 50 to 100 a year, 20 in some cases 200 a year. It just depends on what else I have going on. So I've worked with a lot of families. The majority of them make between 80 to 180,000. That's the middle 50%. But that means 25% of those families make less than 80,000, 25% make more, and in many cases, substantially more. So regardless of where you fall in that, don't assume that you don't get money for college. We want you to go back. You guys should have all seen that info@roncarruthers. Mention the webinar. You'll get a discount. We'll charge 97 bucks for that time. But these are the things you want to focus on. Step one, even if your kid's in college, we got to look at those rules, how they apply to you. If you've already filled out your forms, by the way, we'll edit them. You'll send them over before we meet, along with some other information, and we'll go over them right on our in-person meeting if you're here in San Diego or Southern California, or a phone call if you're somewhere else in the country. We're going to walk through those things, but these are the steps that you need to take. So that's it. I don't see any questions coming in. I see you guys are still all there. So hopefully that answered them, but definitely go through, reach out to Stephanie, info@roncarruthers.com, book your strategy session. And again, think of it as just an extension of this class, except now we can talk about how to get those results for you. So that's it. We're wrapping up right on time, 1 minute early. And I look forward to chatting with you guys individually, and I hope you learned something tonight. We will chat with you soon.